You're not going to get rich on one deal, two deals, but over an extended period of time, there can be substantial wealth. And so you start to look at your checkbook and you see the returns, whether they're coming in quarterly or monthly, and you just feel blessed, and you want to give back and help out other people as well, and both financially and educational wise in this space. And I'm having fun.
Welcome to the Threefold Real Estate Investing Podcast. This is the podcast where you'll not only learn how you can achieve massive success in multifamily real estate investing, but also how you can simultaneously pursue great relationships with your family and a better walk with God. You can achieve financial freedom through real estate investing without sacrificing the relationships that mean the most to you. Now, here's your host, Lee Yoder.
Welcome back, Threefold listeners. I hope you had a great Thanksgiving week. This is the week after Thanksgiving. Not exactly sure when this will release, but hope you had a great Thanksgiving week with your family and friends, however you decide to celebrate that. And I know my family and I really got to enjoy some nice time together. I was just sharing that with our guest, Randy Langenderfer. He had a great time with his family. He's down in Texas, coming to us today from Texas. But a little bit about him, and then we'll bring Randy in. He is the president of InvestArk Properties, focusing on creating investor value and passive income returns for the busy professional. He's been in multifamily real estate since 2014 as both a general partner in 1,100 doors and a limited partner in over 4,000 doors. So for the busy professional who wants to include multifamily in their portfolio, Randy and I share a belief that's something almost everybody should be doing. If you agree, InvestArk provides an opportunity to partner with experts who are aligned with their investment goals. So love that, Randy. You and I are very well aligned in what we're trying to do and what we think about real estate. So so glad to have you back. Thanks for joining us again today, Randy.
Lee, it's a pleasure, my friend. It's good to see you again. I really enjoy your post, hearing about your kids and your family.
Oh, thank you.
Keep it up, man. Those are treasures.
I mentioned Randy's coming back. So Randy was on episode 55. So I highly encourage you to go back and listen to that. I had a great interview with Randy back then. It was just a little over a year ago. Really got into his story and how he got into real estate. Randy had a full-time job at the time. Randy, and you still do, right, Randy?
I do, sir. Just for a very few short months.
Awesome. Well, we'll talk more about that. That's really exciting. His story is very relatable. Nothing spectacular. Actually kind of got started late. So if you're thinking, it's too late for you to get into real estate, Randy's a great example that it's not too late to get into real estate. He got involved later. And I mean, I just read the numbers, over 1,000 doors as a GP, 4,000 doors as a limited partner, just being a passive investor in those deals. So great stuff. Randy, we won't rehash all that because it's on episode 55, but for those maybe hearing for the first time, can you just give us the real condensed version of kind of how you got into real estate and maybe almost just kind of fast forward us right up to today?
I'll try to do it as quickly as I can, but
Sure.
Thanks again for the opportunity to be on your show. I really appreciate it.
Yeah, absolutely.
Randy Langenderfer, Houston, Texas. As Lee said, I came down here 2014 or 2013, actually. So I've been almost 10 years. But my journey started back when I lived in Cleveland, Ohio market, and I worked for a private equity company, and I had a brother-in-law get me into single family flipping. We were hard money lenders. And when I came to Texas for business purposes, I found multifamily, and I've just never really turned back. I really like the asset class. I haven't found really anything else that I think is better at this point for me personally. Mm-hmm. And I've really grown my portfolio and focused on educating myself and growing my portfolio over the last 9 years doing this, and look forward to doing a whole lot more as I'm going to be stepping aside from the corporate world here in the near future and going to do this full time.
So Randy, when you started getting into multifamily specifically, tell me a little bit more about why you think it's the best. I mean, you've been in it long enough now, so it's not just shiny object syndrome and something you saw and got really excited about. I mean, you've been into it a long time. You've seen it. You've experienced it. You're still really into it. Now you're bringing in others, right? Now you're attracting others to the space because you believe in it so much, and you've had time in it to really see that it works. I mean, heck, it's been working for hundreds of years. You and I aren't reinventing the wheel. We're just following those guys and girls that have done it really well before us. But you've been doing it for a while now. What is it about multifamily that makes you want to invest and even bring others in to invest?
The thing that really attracted me the first time, Lee, when I got educated on, is I had been trying to buy a business prior to that, and I realized that to buy a business, I was going to have to sign a personally guaranteed a loan, whatever it was, and I would have to guarantee that loan with the assets that I had accumulated: my house, my automobiles, my investment portfolio, what I had. And when I learned about multifamily and non-recourse loans, that was really a game changer for me initially.
Yeah.
It attracted me
Yeah.
to the space that I can buy a multi-million-dollar asset probably easier because it's guaranteed by the property than I have to get a primary principal loan. And then it's, fast forward, and when you learn about the wealth creation through it, the passive income, everybody needs a place to live. So it differentiates it from other commercial real estate properties. It's evaluated on a commercial basis, the NOI growth versus the comps of a single family. So those are just 3 or 4 things off the top of my head that really clicked with me and said, I want to know more. And so I started investing.
That debt piece is really important, Randy. You mentioned the term non-recourse. Tell us a little bit more about that real quick. You kind of explained it, but just maybe go a little bit more in depth.
So for your listeners who may not be familiar with that term, so when you buy your primary residence, that's a recourse loan. So if you were to default, the bank could come after you for your personal assets if they chose to.
They can take your cars. If you have equity in your
cars, they can take your investments. They could garnish your wages.
They wouldn't take your wife, but they could take your possessions.
Some days I wish they'd take my children. But anyway.
Well, she was. I know she does.
But on a non-recourse loan, the loan is guaranteed by the asset or the apartment building. So in the absolute worst case, if the bottom were to drop out, you'd give the keys to the apartments back to the bank. You would lose your investment. But they couldn't come after you personally.
Right.
And so at the season of life I was at, and I'm not rich and I didn't have a bunch of assets, but I did have some, and I didn't want to lose what I did have. So that's the advantage of non-recourse.
Yeah. And so what I feel like you're really talking about, Randy, is just the downside risk, like worst case scenario. Yeah. What is the worst case scenario? And a worst case scenario of not only losing your investment, but losing your personal residence, losing your cars, losing, all the assets. I mean, that's a really, really far downside risk, right? I mean, that's pretty scary. But to think like, okay, I'm going to invest in this, and worst case scenario is I lose this investment. That's a lot different. That feels a lot better. And then because something that I think people should get to know that is the idea of a risk adjusted return. Because sure, you can invest in cryptos and the upside is tremendous. The downside, and how likely is the downside? We're finding out it's fairly likely. You can, right? You can lose it all, and you can lose it all pretty easily. Now, real estate, I mean, we're talking about worst case scenario, Randy, but we know very well multifamilies hardly ever default. I mean, going back to, the 08 financial crisis, I mean, at a rate of 1/10 of single family homes, maybe not even quite that high, but very, very low default risk. But you still want to keep that in mind. So what is the downside? And we're talking about with a non-recourse loan, downside is you just lose the investment. So that's when we talk about the upside being tremendous, and you talked about it, Randy, the incredible wealth creation, that's great. But what's my risk? Well, with a non-recourse loan, it's much lower. And then the other thing, Randy, what's incredible is like, you get to take on this leverage. So leverage, I mean, if people think about leverage, especially like when investing in stocks and anything else, you better be thinking you're increasing your risk, because that's what you're doing. When you're taking on leverage, you're increasing your risk. So when you buy a multifamily property, when we buy a $10 million apartment building, Randy, right? Like the bank is going to pay for 75% of that potentially, right? So the bank is going to put up 7.5 million of the 10 million. We got to put up 2.5. So you're taking on this leverage, which does increase your risk for sure, because, you only have, 25% equity in it or whatever. Okay. But when you increase leverage, you increase your returns. So you have more upside potential. What's the downside? It's just to lose the property. So the bank is taking on 75% of the risk. You're taking on 25%. You get to experience all of the upside. Right? So tons of upside, and your downside risk is limited to just losing that investment. So I love that you built that out a little bit, Randy. And it's such an important point, because you want the upside. Of course, we want wealth creation. That's why we're into this. But you've got to limit your downside risk. And I think maybe I'm thinking about it more today, Randy, because I think it's more prescient today. I think it's more in the forefront of people's minds, because for the first time in a long time, people have lost a significant amount of money in the stock market and bond market. And if you've been in crypto or anything else, I mean, you see now, like, you can lose pretty quickly. And multifamily is a very stable investment. Even though you take on leverage and there is risk, you can have a non-recourse loan, and it's very limited.
And that risk adjusted is so key. You explained it very eloquently. I mean, it's great. I love, that's what the illustration I use about when I buy stocks and bonds, I got to pay 100% of it. When I'm buying a multifamily, I only got to pay for 20, 25, maybe 30% of it in the worst case. Right. And then I coach also on this stuff today. And so I also, talk to people about risk adjusted. And so you're risk adjusting. I encourage people to to look at as passive investors. I focus on the Sun Belt region for me, the South, where populations are growing and where income is growing. Large areas, Texas, the Carolinas, the Phoenix areas. I believe that's another risk mitigation strategy versus, no disrespect, somebody called me about Topeka, Kansas. I don't know anything about Topeka. Maybe it's good even, but another risk. And then you look at the best way to risk adjust your returns is, right, you want to look for operators who've got a proven track record, somebody that's been there and done it. Those are just some of the things you start to look at for risk adjusting it as well. So there are other factors besides the non-recourse, but that people need to understand that.
Absolutely. Yeah.
It'd be a terrible thing. I've never lost any money in real estate. I don't know of anybody that's had one default, but if that were ever to happen, it's limited to your investment. So.
Well, and you just named three big ones. I heard somebody say the other day, I don't know if this is true. They weren't necessarily saying it as an actual fact, but they said 99% of the time when somebody does default, it's a debt issue. And so we brought that up early, Randy. It's so important to get good debt on these properties. And I know that's something that you focus on a lot. And we kind of mentioned that. And then you mentioned the other, being in a good market. I mean, extremely important. And then I think the most important one, as a passive investor is the jockey, is the sponsor, the person that's driving the investment, running the investment. Because I think we both agree, Randy, that, you can buy in the right market, you can buy a good property, you can get good debt on it. You've got to operate it well. And that's up to the sponsor. I mean, a bad sponsor can turn a good deal into a bad deal, and a good sponsor can, take a bad deal or a decent deal and make it good. So those are three great things, Randy. I mean, really well said there. As you alluded to earlier, you're getting ready to quit the W-2, man, to hang it up. What part has real estate played in that? Like, not specifics, but just, where are you at, and how has real estate maybe played into you being able to step away and maybe a little bit earlier than you thought, or, what's that look like for you?
So fast forward today, and that's the approach I took. So I studied it for probably a year, 9 months before I pulled the trigger, and I pulled the trigger with my hands shaking, writing a check, but I did it. And then you fast forward to one property, two properties. And you mentioned I did start later in life. I was in my mid 50s when I started. Okay. And so I'm in my 60s today, and that some may have turned some off and become risk adverse. And so de-risk, the other one I got to mention and throw in there is, in my day job, we talk about portfolio diversification all the time. I work at a large academic medical center, and I talk to the chief investment officer, and we talk about diversification. Well, for the first time, I work at an organization that has a multi-billion-dollar portfolio endowment. Yeah. And they invest it. And for the first time in about the last 5 years, it used to be stocks and bonds. And so even to the high net worth individual that I talk with, I say, you should think about diversification. It's stocks, bonds, keep that. But in a $2 billion portfolio, we have between 8 and 12% allocated on a corporate endowment perspective to real estate.
Oh, great.
Now you think about that. That's a lot of dollars. Sure. And I don't know if they're in, I don't know what kind of real estate they're in, but they've designated a piece of their diversification strategy to real estate specifically. It used to be buried in a line item called alternative investments. So now it's stocks, bonds, real estate, alternative investments. Okay. So the fact that has been called out in a lot of big portfolios, and why it has, is just purely diversification. So to your high net worth audience out there, that's something to consider. If you're on the beginning end of your investment journey and you say, thank you, Randy, I'm not high net worth yet, but I do want to invest. It's a great way to develop passive income. And that's what got me going, is I wanted to create another income stream. I knew I wasn't going to get rich off of one property, and I wouldn't get rich off 3 or 4, but over a period of time of accumulating them, reinvesting all the returns, I had a very substantial run. I can tell you in 9 years, looking at all the properties that I've been in, I've probably been in about 25, 30 properties, going full cycle on 15 of them. Wow. I'm averaging 160% return. So that means for your listening audience, for every dollar invested, I got $2.60 back over a 9-year period. I'm pretty content with that. I think that was, and to your point, I'm not any smarter than anybody else in your podcast. It's just taking a little bit of risk and understanding your risk. Going back to that risk, educate yourself. Otherwise, you're just speculating. But you don't want to speculate. You want to understand what the risk performances are. So I've studied this. I've then invested in it. I've become a sponsor because that's what I wanted to do, and the returns are even better there.
Yep.
And so now I'm saying I want to do this full time. So I am leaving the corporate world in Q1 of next year, the end of Q1, and I'm going to be doing this full time, hoping to put more deals together. Gotten comfortable with real estate and the returns, and say why go further. So
yeah, Randy, congrats on being able to step away. That's got to be so exciting for you, your wife, your family, to be able to do that this coming end of first quarter.
I keep asking my wife if she wants me home every day, all day. So far, she's still saying yes, but
well, she hasn't experienced it in a long time, Randy. So let's let her make her decision after she, gets to experience it for maybe a quarter or two.
Well,
right.
We just, you actually hit me on a good day. Today is my 41st wedding anniversary.
Oh, wow. Wow. Congratulations, Randy.
I think she'll be able to put up with me.
Good for you. Yeah, I would say so. Yeah, that's so exciting. And Randy, I mean, talking about your returns, I mean, that's fantastic. And I'm sure has set you up. But the other thing that I love about real estate is not just the buying and selling and the returns, but the cash flow. And with you being, so well invested in real estate, I'm guessing that's got to make you feel so much more comfortable about your retirement with, hey, not only have we built this nest egg, because everybody tries to do that. I mean, that's the general plan is, hey, by the time we retire, let's try to have 2 million, right? Like if we have 2 million, I mean, I feel like it used to be 1 million and now it's probably 2, but if we have 2 million, then, that's just going to dwindle. It's going to go down, but that should last us for another, 20, 25 years or whatever. And we'll probably be dead by then, right? Yeah. That's kind of the general retirement plan. I'm guessing, Randy, yours is a little bit different. You have the nest egg. So you've got that, but you've also got investments that are going to continue paying you. They're not going to go down. They should be going in the other direction, right? So tell me a little bit about that. How you're
I mean, I just keep, we live very modestly. Sure. We don't live extravagantly. We live very modestly, and I just keep plowing back into more assets. So, it's a first world problem when I had my millennial daughter invested, me and her husband invested one recently, and we just got paid out last week. And so they're just kind of, they see the lights now. Yeah. And they're beginning to get it. And what do we invest in next? What do we invest in next? And so, we'll find something that's cool. Uh-huh. But, 1 becomes 2, 2 becomes 4. That's the kind of math I can understand, Lee.
Yeah. Right.
And over a period of time, a period of time, you're not going to get rich on 1 deal, 2 deals, but over an extended period of time, there can be substantial wealth. And so
absolutely,
you start to look at your checkbook and you see the returns, whether they're coming in quarterly or monthly, and you just feel blessed, and you want to give back and help out other people as well, and both financially and educational wise in this space. And I'm having fun.
Yeah. You mentioned, I mean, over time, it's almost, real estate is an illiquid investment, and it's almost a benefit because you have to leave it in. And typically, a lot of investments, if you just leave it alone, it does well. And real estate is certainly that way. You make good cash flow throughout the investment. You should, and then you get this really big bump if it does sell. And you left alone for 5 years, and like you said, I mean, your daughter and her husband all of a sudden, oh my goodness, like we let this money go for a few years, and wow, like it's a game changer. So that's exciting.
That's exactly where they're at. Actually, it was. You'll love this one. It's a sponsor we will both know that I won't mention, but. The asset was in Columbus, Ohio, and we owned it 34 months and tripled our money.
Gee whiz. Yeah.
And, so before they were kind of reluctant, and they knew I was in the space, and they just threw some money at it because I was doing it and I gave them the sponsor, but it turned out very well. And so now they want to do more. Exciting. And, they're looking at it as a college fund for their kids.
Yeah.
They're looking at it as a college fund for their kids.
Yep.
Just that if they can do 2 or 3 more before, their youngest or the oldest has to go to college in about 13 years. Then, so it's a great strategy there. I hadn't even thought of until she mentioned that. And I thought, wow, that's a good idea.
Oh, it's a great idea. Randy, this is making me think, I know you really like to give back, and I mean, this is one way you're doing it. I mean, you're educating, your family, getting them into these great investments, that can be life-changing for them. And you're doing it with a bunch of other people. Is that how you like to give back?
So I would answer that twofold, Lee. First, on a professional basis, I give back. I'm doing coaching on the multifamily space. I hope to do more of that as my calendar opens up, and I do make some money at that, but that's not a lot of money. It's more charitable than it is. I view it more charitable than it is monetarily.
Sure. Oh, I'm sure.
And then, the why is, why would somebody do this at the season of life I'm in or other people's life, whether you're So many
Yeah, because you
people.
probably don't have to, right, Randy? I mean, you could probably go sit on a beach, couldn't you?
Well, I don't think I'll ever sit on a beach, but I mean, I could in terms
Yeah.
of been a long run in the corporate world and have done outside investments, so I'm blessed in that manner. But
Yeah.
I mean, the reason for me personally is one is just generational wealth and to give back to the charitable organizations that I've designated and said that I just don't really think that I'm done yet. I think that the good book tells us we're supposed to sow the field and work, and not necessarily. I enjoy golf, but I don't really want to play golf 4 days a week, and so I just really enjoy this. And after doing it in the corporate world for so long, Lee, I'm not arrogant, but I'm pretty competent at what I'm doing, and it's not intellectually stimulating to me anymore. Where the real estate world is just really intellectually stimulating and keeps me going, and I don't mind working. I mean, I'm getting up in the morning, early in the morning, late at night, recording these podcasts and looking at properties and do the stuff you're doing too. So it's fun.
Oh yeah. It's important to have fulfilling work. I think that's great, right? I mean, it's going to keep you young and vibrant and active and healthy, I think too. And you're helping others. I mean, it's fantastic. That's really good stuff. Along those lines, Randy, helping others get into it, coaching. I always like to ask, so you'd be a great person to ask this. What's the key ingredient to being a good investor? Maybe you're talking mostly to passive investors or people that want to get started, but what do you think is that key ingredient to have success in real estate?
Twofold, I would answer that question. One is education of yourself. Educate yourself. I call it, Lee's a great guy, so here's $50,000, go put it apart. That's speculation.
Sure.
And Lee is a great guy, but I want to be an investor, not a speculator. And an investor understands the business plan and the associated risk, because there are risks with all of them. Yep. Trees don't go to the sky, and their businesses, and we're finding now about cash flowing and these changing times, and so their businesses. Educate yourself. And the second one I would say is take the long view. So I mentioned I've had some successes in that return, but in that 160%, I have a zero also, a zero property that returns zero, none, nada, nothing.
Yeah.
And so it's not all gravy. I'm not here to tell you that. And some have been disappointing, while others have been with those kinds of return. Others have been extremely blew out of the water, the pro formas. And so educate yourself and take the long view would be my summary.
Great ones. I'm not going to add anything, Randy. I totally agree with that. I know you're a man of faith. Family is extremely important to you. So I know you and I are very well aligned in this. So I love asking this question too. And I'm looking forward to asking you this specifically, Randy. But how do you then, while having success in real estate, what's a key ingredient, or maybe, what are you and your wife doing to make sure that, while you're going at this, Randy, because I mean, I can tell you're passionate about it, even though you're, letting go the W-2. I know you're going to stay busy and you're going to hit this full steam ahead, but how do you make sure that you're having success in things that are more important, that you and I think are more important, our faith, following Jesus, and our family, while having success in real estate? Because that's what we want. We want people to have success in real estate, but there's other things that are far more important. How do you maintain your priorities, Randy?
That's a daily challenge for all of us, right? I would say first and foremost, it's only by prayer and concentration to say, remind me why I'm here, Lord. It's not for my benefit, but it's for your glory. And then the short one is I have a wife that reminds me daily.
Yep. Oh, me too.
I have a wife that reminds me all the time that I'm not as good as I think I am, and the work
you're doing is not as important as you think it is. Right?
It's really important to me at the time, and I love being on podcasts and stuff like this, but she grounds me very nicely and in a loving manner and in a great manner. So I really appreciate that in her.
Yep.
But as you grow older, I seek returns and stuff like that, but you just realize it's very important, but it's not the thing. Sure. And if you've ever talked to anybody that's really rich, they tell you these things. It's not the money that really gives you fulfillment. It's giving back. It's helping others along the way. And I'm just finding that to be very true. Yeah.
No, absolutely. I mean, Randy, you and I are talking, I know you have kids that you're extremely proud of. Now you got grandkids, and kids do such a good job of teaching that, because I know when you have kids, you just want to spend time with them. You've got grandkids now. You just want to spend time with them, and they don't give a rip about how much money you have. Now it opens some doors, and I love traveling, love taking our kids. I want to take them all over the world, but man, at the end of the day, all my son wants to do is pass a ball. So that's another good way. You just were making me think of that, thinking of family, and it's just important to have people around you that ground you. I think that's so well said, Randy. It's such a help to have people that bring you, that ground you.
What's it, a $5 ball or a $10 or $30 glove? I don't know what a glove costs these days. I mean, but right? He doesn't care. The dad's on podcast and speaking and doing these things. Matter of fact, my kids periodically when we look at things remind me of all the things I do wrong on them. But
I bet
another grounding aspect. But absolutely, that's the fun part. That's the fun part of being able to see their joy in those simple, basic things of life. So
really good stuff, Randy. Hey, I always like to ask for a good book recommendation. You got anything you're reading lately, or what do you maybe just the one or two in general that you point people toward if they're getting interested? What do you tell them to read?
Well, I mean, I think the one that where is that at? Passive Income. Yeah. Well, there's two books. I mean, you always got to say the first most important, the best book ever written is the Bible, right?
Absolutely.
So I always encourage that. But on a income or on a real estate side, I really love Anthony Vinceau, Passive Investing Made Simple.
Oh, okay, yeah.
It's been out for a while now.
Yeah.
It's the last one I read, but they do a really well job at it.
And that book gives them the good questions, but that book also kind of, for you and I and others that want to do it actively or are doing it actively, it tells us the questions that we should be asked and the questions we should be able to answer. Right. So I love that book on both ends. Hey, real quick, because I didn't get to ask you this yet, Randy. I mean, you're very active, you're involved. I see that you're still doing deals, still raising money. What do you think of the investing atmosphere right now? Fed's raising interest rates, inflation's still hot. How are you looking at things right now? Are you less aggressive? You're still putting offers out there. Yeah. What are you doing? What are you seeing?
Well, everybody's got their own personal risk tolerance. And I have investors saying, thank you very much, Randy, go away for 6 months and come back when it's stable, or more stable or more clear. But I am still very bullish on this space. I think that we buy differently than we did. Well, first of all, I would say, I think this is going to distinguish it. This is going to be the year of the operator. The next coming years is going to be the year of the operator and distinguish good operators from average operators.
For sure.
And how they're running properties. But I mean, back to that, I'm very bullish on the market still. I think that, you just buy differently today than you did 2 years ago or even a year ago.
Yeah.
And you have to take that into consideration. You mentioned debt. That's the most important thing and how we're getting debt today. So I've done 4 deals in 22 and they've all been with variable debt. 3 of them have rate caps on them. So that's another risk mitigation strategy for your audience to make sure that if the sponsor is getting variable rate debt, that they have some kind of rate cap on it.
Yep.
So that rose so fast, as we all know now, that it just blew through the strike price of those rate caps. And, we've been collecting that now 3-4 months. And thank goodness we had the rate cap. But so the challenges isn't going forward is I think you're going to see, I haven't seen prices come down yet. Maybe you have in your markets, but I haven't seen prices.
We definitely have a little bit, just not enough.
Yeah. And I see properties on the market a lot longer, and some of them are starting to go off market rather than being full blown listed and want some kind of competitive bidding process by brokers.
Yep.
I'm currently not underwriting right now only because of the holiday pause, but I'll get back to it the first of the year and start looking at it. So I think, again, for an investor out there, I have a brother-in-law says, oh, well, really risky, bad time. I says, true, but non-recourse debt, cash flowing assets, everybody needs a place to live. These prices aren't going down, in my humble opinion. I don't think the Fed can raise interest rates. My first mortgage was at 11%. That shows my age. And it was an FHA mortgage. And I was happy as a pig in mud to get it. I don't think we're going to see those rates again because Jay Powell will bankrupt the country. I mean, every time we raise rates, and a ton of businesses along with it. Yeah. And it just, it escalates the national debt. Because we're having to pay more. Different today. So I think it's a season that has to be cautionary, but I'm not done accumulating and buying yet. Great answer, Randy. I mean, so you saying, you're still a buyer,
still bullish on it. You're just buying differently. And it sounds like you mentioned two things, maybe being a little bit more conservative even. And then your debt is definitely different, right? Like now you're starting to really think about rate caps and because I mean, interest rates have just blown us away. So is that what you mean? Kind of the buying differently?
That one. And I haven't done this yet, but I'm really thinking about considering agency debt again, Fannie or Freddie.
Okay.
And just recognizing it's going to be a longer hold.
Yep.
It's going to be a 7-year hold rather than a 5-year hold to project it.
Yeah. We probably just had this blow off top. I mean, we reached like peak euphoria. We had a ton of stimulus and people made a ton of money in a couple of years. I mean, you talked about a deal and it's probably not going to be like that again. We just had that. You can't, like you said, trees don't grow to the sky. You can't have a 2 or 3 year period like we just had all the time. It's just not, it's not realistic. And we had incredible, if you bought something in 1920, you did, and you already sold it, you did very, very, very well. And it's not repeatable. It can't be like that all the time. So likely it reverts back to traditional real estate where you hold for a while, you pay down some debt, you collect, some income along the way, you enjoy the tax benefits, you enjoy, slowly over time, the property appreciates and you pay off, some debt and you build equity, right? I mean, that's the beauty of real estate. You don't need it to go crazy like it's done in the past couple of years.
And that isn't going to change. That isn't going to change. And I just think that the syndication model, of which I'm real comfortable with, has gotten spoiled with, like my kid, 34 months or 33 months, whatever it was, and tripling their money. That's a grand slam home run.
Yep.
But I'm really happy with some doubles in there and some triples and not having to do that. So I really look forward to the day. I would love to own my own property. I mean, just own it with a couple of guys. And hold it for 20 years.
Yes. Right.
And cash flow and just go cha-ching, cha-ching, cha-ching every month, see some. Yeah. I'm not there yet.
You'll get there. You'll be there.
That'd be my desire because that's true generational wealth then in my mind. Where you,
I agree with you. Yeah.
Where you have an asset that you just hold. So.
Right. Wow. This has been a lot of fun, Randy. I really appreciate your take on the market, your take on, investing, especially, kind of coming from the passive investor side, because you've done so much of that and you've done so much educating on that, but you've also been there on the other side as a sponsor and an operator. So you can really speak so well to that. So appreciate your take on that, Randy. Love talking about the faith and family side of it. You and I share a passion for that and an idea that stuff's more important. So this has been really helpful. Thank you so much for giving us your time today, Randy. And before I let you go, I always like to ask my guests, how might my listeners and I be praying for you in the coming weeks?
That's really kind of you. I mean, just appreciate the continued safe travels for loved ones, everybody over the holidays. I think you're going to family, my family's coming here and coming from across the country. And so that sticks out in my mind. Pray for wisdom. I seek wisdom and really want to be a good steward going forward. I take using other people's money very seriously. And so I just want to be wisdom. I would summarize wisdom there. So those come top of my mind. Yeah. Good stuff, Randy. Oh, absolutely. We'd love to pray for that for you. I'm always hoping for the same things and praying for the same things. So we'd love to partner with you on that. But Randy, thanks again. This has been a really fun episode. Appreciate you coming back again and sharing your wisdom and your experience with myself and my listeners. Let's do it again sometime. Yeah, great holiday. All right. Take care, Randy.
Thank you for joining us for another great episode. I hope you'll take action on what you've learned today. If you enjoyed today's show, please consider leaving Lee a 5-star rating and review. And check him out on threefoldrei.com. Until next time, 1 Timothy 6:17.